Let me just update you. I thought it'd be helpful just to talk a little bit about what we're seeing in the marketplace today. I think, like I've heard some press now that there's a frenzy. I'm not sure if you guys have seen that there's an M&A frenzy. I don't quite share their levels of exuberance on that one. I think the conditions are right for a frenzy. I see that there's high pressure on pricing. And I was just talking to some guys here today complaining that deal flow is tough because of valuations. But what we're seeing is lots of cash on corporate balance sheets. And a couple slides in, I'm going to talk to you a little bit about how much cash that really is. Lots of available capital, low interest rates, and low organic growth. And I think, subject to what happens in Canada, the U.S., or China and the U.S. on their economic policies and growth, war in wherever there are wars, and terrorism in, well, we don't know in Canada yet, but subject to all of that happening, a lot of the factors that were holding people back from making acquisitions, there was always a reason not to do it because people were concerned. So, like there was the Eurozone, is Greece going to fail? Is there a hard landing? Is there soft landing? Is there fiscal cliffs? All of that stuff's been pushed behind us in a way. And now corporate executives are looking at that and saying, okay, now a lot of the uncertainty is gone. It's time to get on with business. And the markets, what we're seeing is the financial markets are encouraging companies who are making acquisitions. And the way they track that is what happens to the stock price the day after the announcement of an acquisition. So I thought the quote from Barron's was fairly interesting. The quote was basically, the problem we have is we're living in a low-growth, slow-growth economy, but the markets reward growth. So if you're a CEO of a company and the market rewards you for growth, but you don't have the ability to grow organically, what are you going to do? Well, that comes down, you make acquisitions. How do I go back? This is the joy of technology here. Okay, there we go. So one of the things that's driving some of the acquisition is there's been some really large deals announced. On that page, these are the top 15 up to the first half of the year from Thomson Reuters. There's $500 billion of announced acquisitions there. As Jordan said, we haven't advised on any of those yet, but I'm waiting for my phone to ring. Okay, but the lead off is, if you can see that Comcast is taking a look at Time Warner for $70 billion. Okay, so that's not chump change. So here's what people are saying is driving the global market. This is why people are saying there's a frenzy. If you look at these are 9-month comparatives, okay, from 2007 through 2014, 9-month comparative globally on announced volumes. And you'll see that we're at $2.7 trillion of announced transactions through this year. And you think that's up significantly from last year, the same nine-month term. But the problem that I don't pay a lot of attention to the dollar value of the announced transactions. I pay more attention to the number of transactions. Because what happens is it's very easy for the stats to be distorted based on some larger deals. So if you knock out those top 15 deals, that knocks $500 billion off of that. So what I've done is we've plotted out in the red boxes the number of transactions. And you'll see it doesn't look like a frenzy, right? So I would just caution you when you're listening and talking to people, pay attention to the number of transactions because that's a better indicator than the dollar value of the transactions because it can be really distortive. It's sort of like what Mark Twain said about 3 kinds of lies. Well, there are 3 kinds of lies. Lies, damn lies, and statistics. Okay, so take the statistics with a grain of salt. But there's one thing I'd just like to jump in on this, and it's not on any of the slides, but how many of you have heard that statistic that 70% of all acquisitions fail. Is that, you've heard of that? Yeah. Yeah. And if you're looking at an acquisition program, you need to be prepared on the naysayers to say, well, did you know 70% of all acquisitions fail? So, and there's strong statements. Forbes recently came out with a statement in one of their articles that said, you know, when all the dust settles, when all the ifs, ands, and buts have been examined, 70% fail. So, to me, if I look at 30,000 or 40,000 M&A transactions every year, to me it's inconceivable that 70% of those are failures. Like if there were, that line would just be cratering down to zero, right? So what we did is we dug in a little bit to say, why is that people are saying 70% of all acquisitions fail? And the reason is a lot of the research takes place around public companies buying public companies and comparing the stock price around the date of acquisition. And if the stock price dips at all in the few days after the acquisition, it's considered a failure. Okay? Now, if you believe in efficient capital markets, then and I think that our capital markets in the West are fairly efficient. You would know that the announcements of public acquisitions have already been in the press for a long period of time. They've been in months, right? The speculation and then the announcements have been there for months. And that transaction is already fully priced in the share price, right? So once it's completed, it takes some of the pressure off the share price, and it would be a logical thing to see the share price drop by 1%. And to me, that does not warrant the descriptor of a failure. So, let me do it again here. Okay, so I talked a little bit about cash positions in selected industries. What we did is we did a composite of the different industries that you all work in. And we've included this slide in your takeaways. But this is within the past few days. We went through the different industries, areas, and said, what are the top 25 public companies in the U.S. sitting on in their balance sheet for cash? So just the top 25 companies in building products, $4.6 billion. The top 25 companies in software and IT, $260 billion. This is cash on their balance sheet. It's not available credit, it's cash. So just in that list there's $500 billion of money sitting available. Now you leverage that up with cash, and you'll start to see a picture of there is coming an imperative for the CEOs of these companies to start taking a look at that and say, what do we do with this cash, right? So that represents almost 8% of the trading value, of the market capitalization of those companies is sitting in cash. I think it goes even beyond that. So Bain recently did a study, and they said, this is Bain's estimate, $300 trillion, that's $1 trillion, is available today for investment. Barron's estimates the non-financial S&P 500 holds $1.4 billion of cash. This is cash, okay? And then Capital IQ is talking about private equity groups holding $1 trillion of available capital for investment. Like, this is a lot of money. If the Canadian government's annual budget is $500 billion, this is twice what the government of Canada would spend just in the equity groups, twice what they have available. So what do I see? Well, what I'm convinced of is that acquisitions are an industry that run on optimism, and they're fueled by capital. So I see the doubts are leaving, and the optimism is returning. I see a ton of capital available to do this. And if you've read Malcolm Gladwell, he's got this phrase, the tipping point. I think there's a tipping point coming where people are going to start saying, if there's a trickle, a slight uptick in the numbers of acquisitions, then there's going to be a tipping point where people jump in and start going, we need to get going on this too. It's like a herd tendency. And when that comes, hold on, because I think we're going to see some really significant acquisition activity, and we're going to see industries changed. Okay. That's just my speculation, okay? And I've heard people say that for a long time, but that's where I think that we're going. So the next topic that I'd like to just walk through is a framework for M&A. So we've done, 50 buy-side deals in the last few years and several hundred sell-side deals. And there's been a common thread flow through that when dealing with buyers. So you take that process and then multiply it by the number of buyers that we talk to through that, and you'll get a sense that there is some fair empirical data behind this. And what I've seen is that people have there's this ongoing struggle to try and put their heads around what an acquisition looks like, whether they should do it, how do they value it. And there are very few frameworks around that allow people to say, let me just easily plug what we're doing into this. So what we wanted to do is we wanted to say, well, is there a way to look at acquisitions that would allow us to answer 4 questions? The first question is, what's the purpose of the acquisition? The second is, what's the value in the acquisition? The third, what's the value of the acquisition? And the fourth, how do we integrate this thing? Or if you want to put it a bit more in layman's terms, what's our goal? What does it have? What do we pay for it? And what do we do with it? So we started doing some looking deeper into this. And I'm not sure if you've read anything by Clayton Christensen, but if you haven't, you should. A brilliant guy, professor at Harvard. I've grown a great appreciation for him and the work that he does. And over a long period of time, the model has developed to look at every business. And I think it will, if you look at your business or any other business, you could break it down into 4 interlocking components. So customer value, what drives customer value? What's the profit formula? What are the resources? And what are the processes? So the customer value is, I'll just drill this down a little bit, okay? So the customer value is what product or service do we do that helps a customer do their job better? Okay? Help them to do something that they can't do already, help them do it cheaper. So the second one is, what's the profit formula? What are our margins? What's the velocity? How do we convert stuff? What's our pricing? You guys can take notes. We are videotaping this, and we're also going to have the slide deck up online if you want it. Okay, so we're going to cover a fair amount of stuff here, and if you want to go back to it, we'll get the stuff out to you. So those are the 2 intangible. But then there's the key processes. Like, how does the company do it? Right? How do things work together on that? What are their processes and policies and procedures that generate the value? And then the next part is, what are the resources? So the resources are the people, the brands, the technology, the things, okay, that you feed into the processes that are driven by the profit formula to satisfy the customer. So if you can keep this kind of in your mind for the next little while, you'll see why we're big proponents now of this. So if you look at an acquisition in 4 boxes, 1, to strategize leads to a search. Once you've found something, it leads to a structure. Once you've bought something, it leads to an integration. I think the framework speaks to the strategy. It allows you to speak to the assessment, It allows you to speak to the valuation and integration. So those are the 4 questions. What are we buying? What's it got? How much is it worth? And what do we do with it? So I'll walk you through how that works. So here's a telling quote, and this is over a period of time we've seen there's 2 failure points on acquisitions. And these are the biggest failure points that we've seen. The first failure point is strategy. It's amazing how many people are looking to buy something without ever defining what their corporate strategy is. Okay? I'm a really firm believer that the very most important thing in any acquisition is why. Okay? If you can't answer the question why, then it's not going to get over the finish line. And I'll tell you why. I'll tell you why that is because at some point throughout the process, the senior decision maker is going to say, can anybody tell me why we're doing this? Right? And if there's not a compelling why, if you can't say, well, we're doing this because it's going to revolutionize our industry, if you can't say we're doing this because it's going to extend our business, if you can't say we're doing this because it's going to generate enhanced profitability over a long period of time, he's going to put his pen down and he's going to say, you know what? Let's find something different. So the starting point for me in any acquisition is defining what your corporate strategy is. I mean, really defining what your corporate strategy is. Not just we want to grow or we want to be the number one in this, but I mean defining the markets you want to take. We could do a whole session on just how you define corporate strategy, but I just want to throw out just one tool that I found very helpful to help think through corporate strategy. Alan Lafley was the chairman of Procter & Gamble. He and Roger Martin, who's the dean of Rotman School of Business, got together and wrote a book called Play to Win. And their recommendation is to say, look, let's deal with 5 questions to define our strategies. This is not really that difficult. There's 5 questions. Okay? What's our winning aspiration? What is success for us? Where are we going to play? How will we win? What do we need to do it? And how do we manage through reporting systems? Okay. So I'm not going to spend a lot of time on that, but there's some really cool tools. If you haven't got a corporate strategy, this is as good a place to start on roughing that out. Okay, it's simple, but this requires a deep knowledge of your own organization, your industry to do that. So, you've got this now on the notepad. You'll see on the inside cover and on there's a handout that we've tried to categorize now acquisitions into really 5 broad categories: financial or portfolio investments, investments that improve your cost structure, investments that will change your or expand your market, investments that disrupt the industry or change the industry, and then investments that disrupt the industry. So some of these investments, acquisitions, they don't nicely fit into just one box, okay? So there's multiple benefits. But the way we have looked at this is that certain of those are really hard to do. Okay, certain of the acquisition strategies are hard to do. So there's one is the buy cheap strategy, which it grieves me to say that my experience with small to mid-sized Canadian business owners, this is their strategy: buy cheap. Okay, and it's like we're looking for a deal. It doesn't matter whether it fits or not, but we're looking for a deal. So I liken this to the guy who's a size 42 suit goes into a men's store and says, guy goes, what size do you want? It doesn't matter as long as it's cheap. And he walks out with a size 62 suit, but he got a good price on it. So that buy cheap strategy, I don't think is a wise strategy. It's difficult. Now, there's other strategies in here that are difficult to execute, but long-term valuable. And some of the strategies to execute have to be large. Okay, so, for example, if you want to take a competitor out who's really messing up the pricing in the marketplace, quite often, to have the impact in the marketplace, it has to be a larger competitor, because the small ones typically are small for a reason, and they're not disrupting the industry. So we take these, and I have broken them down. There's really two essential types of acquisitions. There's the acquisition that extends your business, and then there's the acquisition that disrupts the industry. So most of the acquisitions, by far, almost all of the acquisitions we see are extend the business acquisitions. Now, I'll walk through, we're going to just see how the model impacts this here. Okay, so, but first, some of you guys might recognize your names on here. But here's extend the business transactions that we've been involved in the last little while. So, Taurus Freight Systems is, I think they still are, an expert at moving freight out of the U.S. into Canada. Transplace, $2 billion business out of the States, needed help moving freight out of the U.S. into Canada. They bought, Transplace bought Taurus. Beauchart wanted to grow their business through extending a valve line. They bought off a Watts Water Technology company called Flowmatic, one of the leading businesses in valves, a huge brand name. Eaton had a problem with what they call a bundled hose package. You know, when you guys never go to a bar, but if you went to a bar and you press one button for soda and one button for water, that comes out of a hose bundle. Eaton had a problem with the hose bundle. Arrow, a Guelph manufacturer, had a great hose bundle. We put the two of those together, solved the problem. And Tandit bought a company called Liquid Terminals because they needed a terminal here in Oakville to deal with a Sarnia, to complement their Sarnia operation. So those are just some of the extenders. So now let me walk. This is a really interesting one for me. Indigo Books. Now this is backed by Onyx, so there's lots of money and lots of smarts behind this. So if you remember in 2000, so this is a little bit of the passage of time. In 2000, Indigo took a hostile run at Chapters Books, okay, and they bought it. So I can't quite remember what the final valuation was, but it's pushing $200 million. So today, if you look at Indigo, their revenues, we've heard, are $800 million, market cap $200 million, or valuation $200 million. You say, okay, well, that's not disrespectful. Now, versus, they could have at the same time looked at reinventing their business model. Okay, in 2000, Amazon, their market cap was $1 billion, and they made the comparable amount of investment. But what they did is they bought online booksellers in the UK, in Germany, and a couple other places. So now let's roll the clock out. Today, Amazon's revenues, what, $75 billion? Their market cap, $150 billion. Okay? So this is the extend versus reinvent. Okay? Now out of this here, it's something, a strategy that you guys should keep your eyes open to is, at that time, if it was possible, Sears should have bought Amazon. Okay? Because what happens, and this happened to the auto industry, it happened here, and it's going to happen in a number of other industries, where the incumbents they have their business model in their play, and a new entrant comes along at the low end of their game. So it's almost like, give them the little stuff. Let them take it. Okay? Nortel did this with Cisco. Okay? And Cisco ate their lunch, because once you give that new entrant a toehold, the only place for them to go is up. So Intel has really sussed that one out, because what Intel does is when they see a new low-cost entrant coming into the marketplace, they buy the guy out, right? Because they don't want the new low-cost guys coming in and then looking how to get up market. So if there's, in your industry, if there's people who are low-cost entrants, new entrants, low cost. Don't just take that attitude of saying, okay, well, we'll let them do whatever they want to do, because pretty soon there's going to be an elephant or a Goliath sitting there eating your lunch. Okay? It's happened time and time again to companies that we know, well-run companies, and it's not that Nortel made any bad or any mistakes. They just didn't take the proactives. Sears should have done that if they could have. Okay? I think Sears' market cap today is like $5 billion. So just to give you a little taste of that. So MIT just ranked Dow Corning as one of the top 50 disruptive companies. Can you imagine Dow Corning? Well, why is that? Well, because Dow Corning has a commodity product called the roof shingle. And what is Dow Corning doing? Is they are reinventing the roof shingle. And what they're doing is they're putting photovoltaics, okay, solar panels, into the roof shingle. Now, I'm going to be building a new house shortly, and if that's affordable technology, I'm going with Dow Corning's solar panel roof shingles. Now, what happens to everybody else who has a roof shingle? Okay? So this is the decommoditizing strategy, where they take a commodity product, add functionality to it, and it becomes no longer a commodity, but something that people go, I want to have this because it differentiates my product in the marketplace. So part of that was fueled by an acquisition of a thin cell solar panel developer. So you go, okay, well, that's great. It's technology, it's high tech, but I'm not in the high tech business. So let me just show you this one here. Structural steel, reinventing the cutter. The guy on the right, these are actual time studies. The guy on the right is going to cut a piece of steel that looks like the piece on the left. It's going to take him 2 hours to lay it out and cut it. A lot of the time, he's on his knees. I don't know if he's praying or cutting, but he's on his knees. Now, there's a company that Burlington Automation, based in Hamilton, that developed a machine to do the same thing in 8 minutes. Okay? 8 minutes. So that's a savings of 95% in the labor costs. So this is like a grotty industry, cutting I-beams. And this is playing into a trend of the need for precision in the cuts, number one, and two, a shortage of skilled workers. Okay? So I'm not sure if you know, Apple is building a new headquarters in California. It's a massive, looks like a UFO. But the company that is doing the structural panels is using this technology. So what happened? Well, Lincoln Electric saw this technology, said this is revolutionary technology. This has the ability to change our industry. And a year ago, we sold Burlington Automation to Lincoln. So it happens across every industry. You need to be aware of that. Okay. So moving on now, what's our goal? There's really two goals. It's if you extend the business or you want to transform the business. Now, this is where the model starts to come into play a bit. You cannot transform your business if you buy resources. Okay? You transform your business by buying different business models. Okay? Not resources. So if you're looking at, that's a great product, that doesn't transform your business. If you want to extend your business, okay, here it is. If you want to extend your business without changing your business model, you should be focusing on the resource part of a target. Does it have the valuable resources? Okay, so you should be focusing on the resources that give you value. If you want to transform your business, start with the business model that generates the value. Okay? So it's a good distinction that I found is really helpful in clarifying. If you really want to radically change your business, don't be thinking that you're going to do it through an acquisition based on what the resources in the business are. Okay? So the next part is assessing it. So back to the model again. If you want incremental, you need to look across the range, okay? If you want transformative, don't be looking at resources to do a transformative change. So you can radically drive growth and profitability through changes in the business model, seldom through changes in resources, okay? Does this make sense to you? So what you're looking for is valuable processes. And like by processes, I don't mean how do they order stationery. That is a process, but it's not a valuable process. It's the valuable processes. How do they service customers? How do they get their products where they're going to? How do they manufacture? Those are the valuable processes versus the resources or the people and the products. So as you go through this, you need to understand the value drivers in the business. So if you're buying resources, then just focus on the value of the resources and price off of that. If you're buying a model, then focus on the model. Those are where the value drivers are in the acquisition. Okay. So as you go through, just some things that we've seen. 4 more key questions. When you're at that stage, is the proposed acquisition strategically logical? Does it tie back to the plan? If it doesn't tie back to the plan, like move on, okay? Don't spend a lot of time if it doesn't tie back into plan. We've seen management teams fall into this trap where they fall in love with a deal, and they get to the board level, and the board goes, what did you bring this to me for? You know, because it doesn't track. So they've spent all that time. It's better to drop it quickly and get on to something that will be more fertile. The second question you really need to focus on, are we buying to expand or to transform? Because it'll change how you view that acquisition. And will it build management? And is the combined company capable of doing what we think it's going to do? So now let's just, how do we value the target? Well, this is a really, we do valuations with professional valuators on staff. And I still think it's a dark science. Okay, I shouldn't say that because Homaric's going to take me aside and say, what? But anyway, let me, the right price is not set by the seller. If you're the buyer, the right price is not set by the seller. It's not set by formula. It's not set by investment bankers. The right price is what it's worth to you. Okay? And this is really important. And people get offside so many ways to Sunday that it becomes a real head scratcher. So I've seen, this is like real life, I've seen people go, look, this is a perfect company for us to buy. But, you know, the market for this company is 5.5 times and you want 6.5 times. So I'm not going to buy it. You know? And it's because their perception is that's the valuation, is the market. We can only ever pay market. What they really should be doing is looking at that and say, what's the value to me? So I coach my team to say, look, there's two economics in this. There's the seller's economics and the buyer's economics. In this, you really need to use the buyer economics to set the threshold pricing. Okay, so now let me just kind of flow this through now. If the strategy is based on extending the business, the valuation becomes, I'm going to say really easy, but easier, because the valuation is based on what's the impact on my profits. Okay? And by valuation, I don't mean that this is what you pay the seller. What I mean is this is the top end of what you should ever pay, because it becomes a decision to buy or build. And beyond that, you need to really look hard whether you're buying or building. Does this make sense to you guys? So that sets the top end of your valuation range. Businesses have got in trouble over a long period of time because they've not adhered to this discipline. They've paid more than what the value of the business is with the impact on their profits. So the market valuation, you use that for your negotiating strategy. The impact on your profits, you use that for your pricing discipline. Okay? It's really a key difference. But now, if you're looking at a business that's going to be disruptive, that's different, because quite often the disruptive businesses don't have profits, right? And you're really making a bet on the future. How do you value that? Well, you can't go back and say, what's the impact of my profits? Because odds are it's a little uncertain. So on those, you need to look and say, well, how is the market generally valuing other companies with disruptive technology? And use that as your pricing guideline. So what we've seen is companies in their acquisition programs, they're going to, quite often, they'll be rolling in and overpaying for the extenders and underpaying or trying to underpay for the disruptors, when it should be just the opposite, right? So if you just think back to Chapters versus Amazon, okay? Amazon was buying disruptors, and they've done well by that. So if you want to generate phenomenal growth, it has to be through the disruptors. Okay. So the last part now is integration. Now, here's a standard in the industry that I've seen over many, many years. And I just went, before we did this, I went out and I just said, let me pull some of the comments out of what companies who specialize in integration actually tell people. So we pulled this out, and you can see here that it says, integration is really straightforward. Okay, it's driven on size. Okay, so if it's a tuck-in, it's a tuck-in as if it's less than 10% of the size. It's really simple, complete integration. Okay? As it gets bigger, then we'll decide based on who's got the best practices, whether to integrate or whether we do a cherry pick here or there. But this is where the flaw in the thinking comes. So the two great failures in acquisitions. Number one, strategy. Number two, the inability to integrate properly, or the value destroyed through integration. This is a contributor, a significant contributor to the problem. So what do I mean by that? Well, here, if you've bought a company based on its valuable processes, those processes seldom survive integration, full integration into the other company, because what it does, it puts it in conflict, right? So for example, some companies have, and we've seen this, we will not sell anything unless the gross margin is 40%. Okay? So if somebody wants something at 20%, we're not going to do it. So now they buy something that says, our strong point is customer service. We're not quite as keen on 40%. If we get it, we can, but we're going to service the heck out of our customers, and we're going to grow that way. So now you start putting those two together, and what happens? There's a clash, right? And in the worst case, it destroys the value of both companies, because there's this unresolved. Is it 40% or is it customer service? What if they're in conflict? So the ones that are based on process, you shouldn't integrate. Okay? So no matter what the size is, you shouldn't integrate the ones based on process. The ones based on process, you should leave standing. Okay? Move your key people over, feed it with good resources, but don't try and bring that into your business, and don't try and take your business model and impose it on that, because it'll destroy the processes. The valuable processes that you have decided are what drive the value in the acquisition. Now, if it's key resources, these are easily movable, okay, in most cases. So you integrate the key, if it's just key resources, if it's people, if it's products, grab that, integrate it as quickly as you can, and then get on with life and let that sucker die, okay? So size is not the criteria. It's not the criteria for integration. So can you see how the model starts to fit together? It tells you, sets your strategic goals, it sets valuation goals, it tells you how to integrate the business. Getting ahead of myself now. Okay, so that's how the whole thing works. So it's an integrated, the goals, the purpose, the valuation, the integration. It's simple. It gives us a good framework to look at acquisitions and say, does this make sense? How should we go about doing that? So the next is building the pipeline. So for the uninitiated, the pipeline means deal flow, really, okay? So here's the benefit of a good pipeline. Last year, Sobeys bought Safeway, and the Globe said, you know, anytime you can buy something outside of an auction at a reasonable price, it's a coup. So you guys are all buyers in here. I got to tell you, I use this slide when we're talking to sellers to say you don't want to be part of a coup. Okay, so it's funny how that works. But this is the value of a pipeline. Okay, a pipeline is where you buy stuff outside of an auction. So here's a tale of two pipelines. This almost sounds like Charles Dickens, right? We have great relationships with lots of equity groups, lots of U.S. equity groups and Canadian equity groups. The mid-size equity groups, this is what their deal pipeline looks like, okay? And the bigger ones, it's even worse. But in a good year, those groups will buy two businesses in a good year. To get there, they start by looking at 500. They go, okay, that's interesting. Now we'll select 100 of those to look at. Well, that's nice. We'll issue letters of intent on 20 with the hopes, and that's not accepted letters, but that's how many they'll issue, with the hopes of closing two. The hopes of closing two. We recently did a roll-up for a Canadian distributor, and we were tasked, hired to do that, and we started. Our client didn't bring a list or anything. He said, here's kind of the general parameters, and we developed a list of 160 targets. Of those, our client said, yeah, these 20 I think would be worth taking a look at. And then from there, we zeroed down to initiate contact on 10 of them, and so far we've bought 7. Okay, so the economics are really quite different between the two, and the reason is this is the value of a really focused criteria. So one of the things that we feel strongly about is that when you're building your pipeline, you really need to figure out what it is, where you want to get to, because in life I don't find there's a shortage of information. There's a ton of information, and the volume of information alone is, to me, where the difficulty comes, because you've got to start sifting it through. Now, you could appreciate, if you guys are, for the equity group guys that are here, if you can take the left column and move it to the right column, the efficiencies in your acquisition process, the efficiency ratio of your acquisition process changes dramatically and has a radical impact on your pricing and your portfolio. So for me, the path to acquisitions or deals is paved with information. So, I spend a lot of time just thinking about information, and it's a commodity you all have. Like, we have information about a lot of stuff, but I think in order to be effective in building your pipeline, you need to have a set of parameters to look at information in a philosophical way. So here is kind of how I see information as it relates to building the pipeline. So the first is private knowledge, okay? And what I would call private knowledge is, it would be otherwise known as asymmetrical knowledge. That means knowledge I have, or these people have, who somebody else doesn't have. So think of insider trading. That's asymmetrical private knowledge. Now, in M&A, it's kind of legalized insider trading if it's done properly, because you should be working off of insider knowledge, okay, or proprietary knowledge. Now that knowledge, it's really valuable. If you want to drive an acquisition program, the pursuit should be for private knowledge, okay? Now it's costly, and it's costly because it's valuable. So, and the thing is with private knowledge, if you think of, take a bowl of water and drop food coloring in there, the intensity of the food coloring dissipates, right, fairly quickly. That's what private knowledge is. it loses its value as it dissipates. Right? It's a competitive advantage to you to have private knowledge. Does this make sense, you guys? So for me, the drive on building the pipeline is the drive to gather private knowledge. Knowing things about your industry, about your competitor, about trends, putting those together with insights on how to get stuff done. Okay, so now here is, so translating the M&A strategy into deals to pursue, it's really about the information flow. Okay, so you start with networks, and I'll just explain this a little bit as we go through. It generates information, generates insights, and from there it gives you deals to pursue. So what does all that mean? Well, a network is really building the people that you know, the contacts that you know. Now, it's an interesting study that was done recently that said 75% of networking, 75% of networking, the success in that comes from people who are not strong relationships with you. Okay, so the way they call it is weakly tied. Okay, weak, like is people who are weakly or loosely tied, as opposed to people who are strongly tied. And the reason that is because the people that you're strongly tied to are people in your world. Okay? So it's hard to see what's going on outside of your world if you're just talking to people who are in your world. So what you want to do is you want to build networks of people that are outside of your world because you're looking for the information that's not available in your world. The next is you feed the information, and there's a feedback loop now. Acquiring the information from news sources, from customers, from employees. People are gathering it on job interviews. They're bringing people in to interview. And from competitors, they're getting the information through job interviews. There's 100 different ways of gathering that information. Now, the next thing you need to do is you need to start filtering the information. Okay, and I liken this to mining ore. If you're trying to get gold, you've got to go through a lot of ore in order to get that gold. So now you've got to have a filter for the information. And as you gather that, there starts to become a feedback loop back to change your M&A strategy, back then to develop your network. Who do we need to talk about? So in your network, there's two key people that there should be there. And how I would describe those people are river guides and gatekeepers. Okay? If you've not heard the terminology before, a river guide would be somebody who would be able to say, okay, there's a place you should go look at over there. There's a place that you should go look at over there. Just around that corner, there's something in the industry. So that's a river guide. Now, the gatekeeper is somebody who has and controls access to the information. Okay, so those are the two people. People who can point you in a direction and people who control the information. As you develop your network, you should be looking for those people, the river guides and the gatekeepers, because it starts to change. Now, your network should include investment bankers. It should include your accountants, your lawyers, customers, financial planners, employees, industry people, associations, like that whole big network. And then you need to have an affinity for reading stuff and understanding stuff. Now, it's interesting. I have found over the years that on the acquisition side, it's better to pursue interesting facts than transactions because the interesting information leads to interesting deals. Okay, so it's just, I don't think it's just me, but I've seen that as a really cool way of starting to broaden the horizon on what you should look at and what you could look at and what makes sense. So moving on, so some practical steps. In your organization, if you want to develop this type of information flow, you need to invest. You need to invest in information sources. Okay, it's not a passive exercise. You need to build a system to gather that information. You need to have somebody in your organization who is strong and strong enough and senior enough to able to look at that and gain some insights. And you need to develop some strong filters. Okay, so the strong filters mean we're not even going to spend any time with this because there's absolutely nothing there. It doesn't fit. And then if your strategy is not secret, and this is really important, if it's not secret, then you should tell people, get the word out that you're looking to buy, get the word out what it is you're looking to buy. And the more specific you can be on that, the better it is, because people will be, you'll have more success attracting that kind of information. If you just say, look, we're in an acquisition mode, well, what does that tell you? What would you expect people to tell you about on acquisitions? But if you're saying, we're looking to buy a welding operation focused on the European automakers based in somewhere in Western Europe or Eastern Europe or wherever, then people can go, okay, I know exactly what you're looking for, and I know some people that you could talk to. So be specific on that to the extent you can. But some strategies are secret, right? Because these are competitive. So if your strategy is secret, don't tell anybody, and you have to do it on your own. Get known as an acquisition house. Announce your acquisitions. So, for example, Transforce. You've heard of Transforce. They're the largest trucking company in Canada. They've grown rapidly through acquisitions. We've had discussions on those, on whether they would be open to us providing a service to them to bring deals to them. And here's their response. We are so well known, Doug, that while we appreciate the offer, we're so well known that there's not a trucking deal that's ever going to get done that they're not going to call us about. Okay? And, you know, pretty well, I wouldn't say everyone, but most of the deals that we do have a chat with Transforce to say, is this something that you'd be interested in buying? So if you get that position in your industry, it's going to provide you two things. It's going to provide you great deal flow, but then it's also going to provide you something even better. It's going to provide you a huge amount of information on the competitive landscape, because as you sign the NDAs, you're going to be gathering information and knowledge about specific companies that's not readily available on the market. Okay? Practically, proactively build your network. Well, let me just check and see how we're doing for time. Okay, good. And then I would strongly suggest that you develop a list of companies that you would love to acquire. Okay, and they don't have to be ones you'd like to acquire this year, but over a period of time, these are companies that we'd love to acquire. And then proactively research them, and then start finding out how to get in touch and develop a relationship with the owners. Okay, because the last thing that you want to do on this is to find or to know of a company you'd really like to buy, and then get the announcement that it's already been sold, and you never knew about it. Okay, it happens. It happens. So develop the relationships. So I would be remiss to having you all here and not at least talk about working with an investment banker. Half of the work that we do is buy-side related work, and that means we're advising buyers. So just so that you know, there are firms, we're one of them, that we invest a significant amount of money in building information, developing networks to help our clients get pipelines. Okay, so if the idea of putting in that formal structure into your business is daunting, we can build the pipelines. We can help you build the pipelines, and in addition to that, there's access. Like information is one thing, but then having access to execute is something else. And we have access. I'll give you an example. A large European construction company said, we're looking for something like this in North America. Do you have anything? Well, no, but we know some people. And within 2 days, we're talking to the president of one of the largest construction companies in Canada about an interest in divesting one of the divisions. Okay, so that's access. Having the information that they had divisions, one thing, but the other part then is having the ability to access. And it flips the other way. There's an equipment manufacturer here in Ontario that is getting ready to consider succession planning, and Last week, Jordan called Andrew and said, Andrew, there's a company in the north end of the UK that we think would be a really good buyer for this. Do you know people? And Andrew goes, yeah, actually, we've had a relationship with those guys in the past. Let me give them a call. Okay. Many years ago, I was part of a two-man M&A firm here in Toronto. And, you know, for me, it was really difficult because you'd hold yourself out that you could do global things, but, you know, a few questions and you realize you can't really, it's like more advertising than real. So that was what drove me to move out of a two-man shop into a global firm, because now if you said we need something in India, we have access in India. I've got partners in India. If we need something in China, we have partners in, Andrew's at Shanghai and Hong Kong. If you need somebody in England, we have England, South America. We have people there with real contacts. So just to put just the next part of that would be, we did the same thing where we talked about a company here in Ontario that would have been a good fit for a specific Swiss manufacturer. So I called our partner in Zurich, and I said, do you know the guys there? He goes, yeah, I'm best friends with the chairman. And so once we talked, he goes, oh, and by the way, this other company that's even bigger, I'm best friends with him, and I think this would be a better fit for. So that's access, that's networks, that's how that works. So the next time somebody calls you and says, I got a deal idea for you, don't balk when they say it's going to cost you some money. Okay. Now the U.S. equity groups have really got this nailed down. They're prepared to pay. They see the value, the great value of Canadian equity groups as well. Okay, not yet. Anyway, the U.S. equity groups see the great value of the information, of private proprietary information, and it's pretty well one phone call. I've got an idea for you. We'd love to hear it. We'll protect you. We'll pay you if we do the deal. Okay. Corporations need to have that same kind of attitude, because that's a competitive landscape. You're competing with $1 trillion of capital that are looking for, in many cases, the same deals that you're looking for. So if somebody says, I got a deal for you, at least be receptive to the rest of that discussion. So, moving on. Winning essentials and common pitfalls. So, M&A is a process. This is really, to me, it's quite important. M&A is a process, and it's not an event. So companies, here's kind of a saying. Successful M&A is based on a foundation of an experienced team. You're going to get your lunch eaten if you have a rookie team who's never done this before. Employing committed resources. You need to fund the project if you're going to do it. To targets well tied to the strategy. So this is really, it's got to be tied back to the strategy. Executing with vigorous due diligence. And doing the integration planning faithfully. So that's kind of in a nutshell what that is. But now let me just kind of walk through some specifics on that. I won't cover them all, but in order to have a successful M&A function in your office, you need to have a commitment, an organizational commitment, and that's going to be money, it's going to be people, and if you have a board, the board needs to be fully on side with this here. I'm a big believer in documented processes, right? Because there's a lot of moving parts as you start going down the trail, and you want to have the ability, or in place already, the procedures for approvals, how we're looking at things, what needs to be in place to control this unruly beast as it goes through. So, well-documented process with flexibility. Okay, and then you need the board approval for your strategy. So the board needs to say, yeah, I agree with the strategy. Let's get going on this. We've been engaged on buy-side clients where the management team wants to do an acquisition badly, and it makes good sense, but the board won't agree to it. So we've learned over the years to try and sort out whether there's the backing of the board. Because the last thing you want to do is spend all this time trying to find a really good target, and the board go, what are you guys thinking about? We're not prepared to do acquisitions. Come on, get back and fix things up, you know. Here's a really key point. A senior executive needs to lead this, okay? One of the things that we've seen get in the way of good, solid acquisition processes is where the senior guy drops out of the process halfway through, okay? So he started it, and then as soon as the wheels are in motion, he leaves and he goes and does something else. It's a recipe for disaster, okay? So you need continuity, and you need accountability. So this would be, now when you're starting the search, you need to form the right team. It has to be focused on the criteria. This is, again, tightly tied back to your strategy. It has to be a disciplined process with effective decision-making. You need to have the things lined up already for the decisions along the way. You can't be rethinking the decisions as you get down the road because you've already invested the time and the effort to get there. You can't be re-guessing yourself along the way. The next is, at this stage, we're recommending that people appoint the integration manager because integration, the second leading failure point is problems with integration. So you need to get that integration manager on side right from the earliest stage so that they can start the planning process through, okay? And then the board approval is required as well. So now on the structuring, this is where we tie back into the model. It's a clear understanding of what the value drivers are. Does that make sense? The value drivers, what are you buying? What is it going to impact your profits? What's our valuation ranges? How do we start the integration process? And things like that. Now, at this point, you have the board approval for deals, okay, to go ahead with the deal. Now, if at this point your board is saying to you, let's talk about strategy, how this fits with the strategy, then really what that means is that you've dropped the ball in the process. These should not be valuation questions. These shouldn't be fit questions. These shouldn't be strategy questions. That's not what this is. And if your board is getting involved in those questions at that point, you've waited too long to involve your board. You want to have those issues set behind you. So here's the risk that I've seen companies run, and it happens regularly. It's happened to us when we're selling business. Nothing changes in the target, okay? Everything that the target has said to the buyer remains true. The buyer, all along, yes, we like it, yes, we like it, yes, we like it, it's a great fit, it's a great fit. You get down to the short strokes and we're not interested anymore. Okay, now I understand external factors happen there, but if it's not an external factor and it's an internal factor, then I'll tell you what happens is your reputation as a buyer suffers. A quick no is so much better than this slow, lingering death. Because what you have in the marketplace as a buyer is your personal integrity and your credibility. So for me, when we're looking at selling a business, the number one criteria that we look at ahead of everything else when we look at a buyer is likelihood of closing. And if a buyer has had a track record of walking away, either retrading, that's a nice phrase I've heard, retrading where they issue a letter of intent, they look then to, as the starting point to reduce the pricing. If a buyer has a record of retrading or a record of walking away from the deal, I'll tell you, it gets really hard for us to say, we're going to put you as the recommended buyer. So your credibility in the marketplace as an acquirer is really important, okay? I hope I didn't say that too strongly. Okay, but it is. Now, integration. This is where it's going to win or lose for you. Once you've bought it, you have to start the planning process really early on the integration, because uncertainty kills companies. So if there's uncertainty on the integration, people are, your key employees in the target are going, what's going to happen to me? Where are we going? You need to resolve that quickly. And to do that, you need to start well in advance to get this question solved. So relentless monitoring and accountability. Don't let it go and say, okay, what's going to happen? Relentless monitoring and accountability is the key to this. So Oracle has bought lots of companies, and their approach to this is early identification. Right at this stage here, they start right as soon as the target's identified. How are we going to get it integrated? Because what they're doing is not disruptive. They're looking at extensions. And then they run through that. Within the first 30, 60, 90 days, the integration is done. Okay? Move quickly, eliminate uncertainty, and get moving on. Really important. If you do that, it's going to work well for you. So there's what it looks like in total. I won't ask anybody to memorize that, but that's that. So we're at a point now. I think we've been on time. So if there's any questions, I'll take those. We're going to, at the end of the question period, we're just going to take a couple-minute break while Andrew gets hooked up with the information here, and he's going to talk for 15 or 20 minutes on cross-border transactions. Okay.